Greetings, everybody. My name is Professor Kevin Matthews, and I am the Professor of Accounting 351 at George Mason University, and we're just going over some of the problems that I've assigned to the students. I hope that this generates some value for you. And Chapter 14, where we talk about sale of personal residences, there's some questions that I've issued out to people, and we'll kind of go over these at high levels. I've gone ahead and unassigned the big problem, and I'll probably talk about that in a different video if I end up doing it. But the problems that I'll end up talking about will be the problems that were finally assigned. And I'm sorry for any confusion. It was just kind of a last-minute thing, just because of the fact that I saw that so many of the people were struggling with that last problem. So I told you guys, I'm a dictator, but I'm a benevolent dictator. I try to do what's in the best interest of everybody to induce the learning. Taxpayer owns a home. So first problem I gave to you is a taxpayer owns a home in Salt Lake City. A second home in St. George, Utah. This is still within the same state. How does the taxpayer determine which home is her personal residence for tax purposes? It's usually done on and the answer that they give, there's an old joke that we accountants, we always make fun of lawyers and kiddingly, like brothers and sisters do. And one thing that a lawyer will say, when you give them facts, to a case, and you say, what's the right answer, they'll be like, well, it depends. And that's what it is here. It depends on facts and circumstances. So there's going to be a whole slew of things that are going to end up happening with it. Now, practically speaking, what's going to end up happening is we're going to ask the client, which one do you consider your personal residence and your primary personal residence, and that's what we're going to go with. But because if the taxpayer doesn't really know, that's when it's going to get kind of dicey. And that's, because, if the taxpayer is primarily living in one house and using the other house as sort of like a vacation house, that's usually pretty easy to figure out, from a practical standpoint. But it's pretty much going to be, where do they spend the most of their time, and where is their life really centered around? So if he lives and works in Salt Lake City, and his boat and his fishing rod or her fishing rod are in St. George, Utah, I think that's pretty clear which one's going to be the principal home and which one's not. But there's a whole slew of things that could happen. Where's your primary location of all the clubs that you're a member of? I've heard that one used before. Where does all your mail get sent to? Where does all of your bank accounts reside in? There's a whole slew of things that we kind of use in order to make that determination. The thing I didn't like about this problem is they use two in-state issues. I wish they had used different states, because that's where you're going to probably spend more of your time trying to figure some of this stuff out. What ends up happening, unfortunately, with this is you'll have a situation where, and I had a client I had to deal with once on this, who lived in one state, but wanted to keep the other state as his residence for sentimental reasons. And so he would go home once for 195 days to make sure that he kept that residency at his other state. But his primary job and where his daughter went to school was in the second state. And so it kind of created a little bit of an issue. We had to actually come up with, facts and circumstances that would allow it to fit what he wanted, and, make sure that he was doing things correctly. It wasn't so much about tax avoidance, but like I said, there was sort of a sentimental issue with this. And sometimes, clients, that's what they want to do. Next question we did, taxpayer stays in the second home for the entire month of September, would like the home to fall within the residence with significant use category for tax purposes. What is the maximum number of days he can rent out the home and have it qualify? And so they basically say, the taxpayer must have used the home for personal purposes more than the greater of 14 days or 10%. And then in this situation, use the home for more than 30 days. To qualify, the 30 days must be greater than 10% of the proper days the property is rented out. So if you rent it out for 300 days, and I kind of talked a little bit about this in in class, where we kind of have the three categories where we say rental property is this, personal property is this, and then in the middle is kind of the vacation property. And that's kind of where you probably should be thinking about with this. And so the question, if we have it on the test, isn't going to be worded like this. This is just kind of a convoluted way to word the test. You know, I'm going to give you a situation. You're going to tell me whether it's a rental property, a vacation property, or personal use property. The next question, which is one of the ones that I assigned recently, Steve Pratt, who is single, purchased a home in Spokane, Washington. By the way, that's where I went to college and graduated. That's one reason why I love this question. For $400,000. He moved into his house February 1 of year 1. Lived in his house, a primary residence, until June 30th of year 5, when he sold the home for $700,000. So again, we have realized gain and recognized gain. So before we answer question 1, what is the realized gain? The realized gain is going to be the difference between the $700,000 and the $400,000. That's $300,000. All right. Steve Pratt, who's still single, you know, has a realized gain of $300,000. The section 121 exclusion, if he meets it, which requires 2 years out of the past 5 years, which he definitely meets based on the problem's criteria, he's going to be able to exclude $250,000 from it. And so he's going to basically have a recognized gain of $50,000 as a result of that. Assume the original facts, except that that the home is Steve's vacation home, and he vacations there for 4 months of the year. He does not ever rent it out to others. What gain was to be recognized in the sale of the home? And the answer is that because it's not, it's not used for 2 out of the last 5 years. I mean, well, yeah. I mean, here's the thing. So 4 times 5 would be 20 months. He would never have 24 months of use of the home. So as a result of which, he's going to have to recognize the entire gain of $300,000, and that just stinks. That's when you kind of tell the client that you wish you could do something better and hook them up with a better situation, but that's what they're going to have to do. Assume the original facts, except that Steve is married Stephanie on February 1 of year 3, and the couple lived in the home until they sold it in June of year 5. Under state law, Steve owns the house by himself. How much must Steve and Stephanie recognize on the sale if they assume that they file a joint tax return? And the way that they're kind of looking at this is that 121 is a very generous exclusion. Obviously, because the couple is living there, it's owned and used. I might have a question about whether she actually owns it, since technically speaking, it says here that Steve owned the home by himself. But usually with married people, that's Steve meets the ownership test and Stephanie must meet the principal use test, which obviously she does. And so my understanding was that it's both. And so this is an area where I might want a little bit more understanding of it. Almost never you're going to see this circumstance. Generally speaking, if two people get married, they're going to cohabitate, they're going to co-own the assets. I've only had one time where the house that I owned was not owned by my wife, and that's just because she was a little skittish about getting into real estate at the time, and now she's way beyond it. So every house that we own is jointly owned. Okay. The next question that they have is Peter and Shalene Johnson moving to a new home in the subdivision. There's one of the first homes in the subdivision. During the year, they paid $1,500 in real estate property taxes to the government. $500 to the developer and $900 for real taxes on the land they held as an investment. What amount of property taxes are the Johnsons allowed to deduct, assuming the itemized deductions exceed the standard deductions? Before considering any property tax deductions, before considering any property tax deductions, and they pay $5,000 state income tax and no other deductions. So the answer is that they may deduct $2,400 of the property deductions, because it's the $1,500 paid on their home and then $900 paid in property tax on the land that they're holding as investment. And that's something that I wanted. One reason why I chose this question was I like the fact that because and this is going to really change for 2018, but if you own 15 parcels of land, technically speaking, you can write off the taxes that you pay on all 15 parcels of that land. What's going to hit a lot of people nowadays is that there's the maximum $10,000 deduction on all state and local tax deductions on Schedule A, and as a result of which, it's going to make it a little bit more difficult to do that. But most people think it's only on the 2 primary homes, and that only applies for rental for the interest that you pay on the house. So you need not be concerned with that. They're not allowed to deduct fees paid for water and sewer, which is true. And then, and we talked about this in class when we did the first section. It's ad valorem taxes. It's basically taxes based on value, and so we want to make sure that that they are not dealing with that. After some math, the combined taxable deductions are $7,400, which is the $5,000 plus $2,400, which is under the $10,000 that they may itemized deductions for 2018. So they're going to be more than fine to be able to deduct it. Like I said, the big problem we're not going to really get into, because that's going to eat up a lot of time. And like I said, I'm not making it a required problem anymore. So I want to say thank you very much for watching this video. If you have any questions, please get down to the comment box, and you can go ahead and ask your question in the comment box. If you're one of my students, please reach out to me by my business email, and I'll be very happy to reach out to you and answer your questions post haste. Like I said, please send it to my business email, not to my GMU email. And then, again, if you are not one of my students, feel free to contact me through the comment section below, and I'll get back to you as soon as possible. Thank you.